This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
This is Theriault Media.
Success in real estate has nothing to do with shiny objects. It has everything to do with mastering the basics. The 3 pillars of real estate investing: attract, convert, exit. Matt Theriault has been helping real estate investors do just that for more than a decade now. If you want to make money in real estate, keep listening. If you want it faster, visit reiace.com. Here's Matt.
Hey there, Rockstar. Matt Theriault from Epic Real Estate, where we show people how to invest in real estate using more of their mind than their money, more of their head, less bread, using creative real estate investing strategies with an emphasis on retiring early. Okay, so please, without further ado, please help me welcome back to the show the man, the original man with the longest running real estate investing podcast on iTunes, the one that I'm second only to him, and that is my good friend, Mr. Jason Hartman. Jason, welcome back to the Epic Real Estate Investing Show.
Hey, Matt, it's great to be here.
Yeah, glad to have you back. It's been a couple years, really. I mean, we've seen each other several times in between now and then, but haven't been able to share your wisdom with the Epic family for a while.
We got to do this more often because it is epic.
We do. And I've been giving you a lot of credit lately. You've turned me on to some new ideas and with regard to inflation and refinancing and the use of debt and aligning yourself with the Fed because we don't want to fight the Fed and all this kind of stuff that you talk about that I find so interesting that, I don't know, maybe it puts Mercedes to sleep, right? She doesn't want to do the numbers and the economics. And I was like, no, this is the best part. You got to listen. So we complement each other that way. And I want to talk about that. But before we do, share with me, well, how did last year go for you?
Last year was good. The market is incredible right now. And just from our perspective, and I think you'll agree with me, Matt, most people consider a good market, quote unquote, good, to be a seller's market, right? Mm-hmm. And then that's what's called a good real estate market, right? And then a bad market, when things aren't selling, is also considered a buyer's market, right? So we are definitely in an extremely strong seller's market, probably the strongest I've ever seen in my career. And my career started when I was 19 years old, going to college part-time and selling real estate. So I've seen quite a few cycles now, and this market is absolutely on fire. I mean, the inventory rates are so low. I just read an article, I think it was a Bloomberg article the other day, that likened the housing shortage to Soviet-era shortages with empty shelves in stores, right?
Wow.
And I think you probably feel that it's that way too. Now, nothing will last forever. There will someday be a correction. However, I will just go out and say this on a limb right now. I think a lot of people are predicting this correction to be much sooner than it will actually be, because there are many factors that put the wind at our back. And by the way, this is the other point I want to make, and this is the one I think you'll agree with, by the way. There's a buyer's market, a seller's market, and a broker's market. And since, I'm basically a broker, part of your business is brokerage. And, we like a market, at least I like a market as a middleman, right? I like a market that's sort of even keel. I find a market like this to be very hard to operate in. A lot of clients are very disappointed because they're experiencing multiple offers, competing with properties. Price is going up quickly. They've got to keep adjusting their expectations. They can't find what they want. It's really hard to source inventory. This is not my favorite market at all. So when you said, how are things going? Okay. Last year was good, but it would have been dramatically better if we would have more inventory. So the inventory shortages are constraint. It's the bottleneck.
Yeah, I was just looking at this chart from the National Association of Realtors and Census, and what's the FRB at St. Louis stand for? The Fed.
The Federal Reserve Board
Bank.
of St. Louis. Yeah. Or bank.
And so they're showing the inventory levels, and they are at all-time lows since they were keeping this chart in 91. Mm-hmm. And the turnover is almost zero.
Yeah.
Like it's almost zero. It's pretty amazing. And back in March, April, May, as we went into the lockdowns, I was actually predicting, okay, here it comes. Here comes the crash, right? And it just didn't happen. What are some of the things in play that caused it to actually thrive?
Well, the first one is obviously low interest rates. And, a lot of people who predicted the crash, and now admit that they were wrong, say, well, I didn't know that the government would stimulate, the Federal Reserve would stimulate so much, and other central banks and governments around the world did the same thing. And of course, whenever you have central banks and government, you can never predict that exactly because it's an exogenous force, right? We don't know what they're going to do, but it's not hard to predict that they will come in with the money blazing and the money printing, right? They'll turn on the printing press to solve every problem because that's always their solution. Whenever we see the G7 or the G20, the big industrialized countries meeting at, in Davos, Switzerland, or, now on Zoom or wherever they meet to figure out how they're going to oppress everybody. But whenever they're meeting, all they really have, they call it sophisticated names. They bury a mountain of BS. But at the end of the day, all they're doing is creating fake money out of thin air. That's all they do, right? There's really no other thing. They might do it through increasing the money supply, the credit supply, by buying assets on the open market. They do all kinds of things, but the essence of it is create fake money out of thin air. And there are only two things that give anything value in the world, whether it be a loved one, or it be a diamond, or it be the dollar bills in your wallet, and that is scarcity and utility. Okay? And if money is abundant, or currency, I should say, that's the proper word. It's not money, it's currency. Okay. If currency supply increases, then the utility of it goes down because it has less value, right? So they are taxing us all through the hidden tax called inflation.
And since you brought that up, and I've got like 5 or 6 things I want to talk about, but let's just stay on topic now with that. I've learned a lot about inflation. I got a good, strong understanding, I think, of how it works, and from a general perspective. I know there's you can go down deep rabbit holes, and it can become very complicated. But and a lot of that is great. Thanks to you, I appreciate you. But I mean, it depends on who you listen to, who your information source is. Some people say, "Oh my God, all the stimulus that's happened, it's going to be a huge inflationary market," and we hear the word like hyperinflation come up, and then other side is like, "Nope, not going to happen. Actually, we might be moving into a deflationary status." How do you know?
The study of economics, they say that the study of economics was created to make astrology look respectable. Okay. And so it is very hard. I mean, to be fair to economists, right? And I consider myself an economist, right? An uneducated one. I don't have a degree or anything, but you don't need a degree to be an economist. That's one area you don't need any specific qualification. But, it's very hard to predict the movements of all of these decision makers in the world, right? We've got 7.5 billion or so people, and they're all making decisions, as well as the institutions of which they all are members of, control, right? And it's very hard to predict all of their actions, right? If you knew, then you could easily make predictions. But the one area where it gets really hard to predict is intervention from these extraneous forces like governments and central banks. Mm-hmm. And so it is a pretty tough thing. So I think that it's very hard to try and predict what's going to happen on a micro level. That is really difficult if you ask me. Mm-hmm. So when you get the emails that maybe meant you and I are probably subscribed. Oh, I know I'm subscribed to them. You probably are too, because, we're in the business, right? But probably a lot of your listeners are also subscribing to a lot of different email lists, and they get these newsletters, and there's a lot of, FUD, fear, uncertainty, right? And they're talking about how the world's going to come to an end on, March 12th, because this is going on at, some big meeting, right? And it never happens. They're always wrong, right? This never happens. But the big macro trends, if you look at things on a macro scale, over a kind of a mega trend look, right? What's going to happen in 5 years? What's going to happen in 10 years? I think I can tell you what's going to happen then, okay? I can't tell you what's going to happen next week. That's really tough, okay? But, and the way we should all treat this as investors is we're not investing with our lunch money. We're not investing with money we need to live on. We're investing with the capital we have that is excess capital, right? It's not living expense. It's growth oriented money. And so we shouldn't be looking at these kind of day trader view of the world, right? And I'm not saying certainly traders who are deep experts, they can make money at what they do, but those are people that have spent a lifetime doing this stuff. And it's, for the rest of us, the easy thing is to just look at big megatrends, things that are very likely to happen. And I think those are pretty safe bets.
Got it. So since you said that, in 5 years, what do you think are some of those megatrends that will come to fruition?
Well, I certainly think we will have continued inflation. And there are three basic economic maladies: inflation, deflation, and stagnation. Okay, those are kind of the three. I mean, there are more, but those are the three I sort of put together. And the likelihood is, because we have created all this new fake money out of thin air, we will have less scarcity, and the classic either cause or definition, depending on how you want to say it, of inflation is a large supply of dollars or currency units, yen, dollar, euro, doesn't matter, Mexican peso, Brazilian real, anything, chasing a limited supply of goods and services. That's going to cause the price to go up, because in a free market, when you have everybody beating a path to your door and you can't keep up with the demand, naturally you raise the price until the demand falls off, which, by the way, is an interesting little aside for real estate investors, since we're both real estate investors and your listeners certainly are. I think it's a mistake when you hear these investors say that, they have a portfolio of 30 properties and they have 0 vacancy rate. Well, take a close look at yourself. You might be the loser in that equation, because you're not charging enough. You're not raising your rents enough. You should have a healthy vacancy rate. An optimum vacancy rate would be 6 to 8%, because that means you're pushing your rents up like you should as a landlord. Your expenses increase, right? You should raise your rents, and you should do it just because you can. That's how you win the Landlord of the Year award from me. You won't win it from your tenant, but you'll win it from me. Okay. And so, you've got to raise the price until the demand falls off. That's the way markets work. Right. So do that with your rents too.
Perfect. Okay. So we're expecting the inflation over the next 5 years, at least you are. Yep. And I can't see how it could go any other way based on what I know and what I've seen.
And by the way, we've already had that. You know, people say, and this is such a misnomer when you hear people say, well, they printed all this money during the Great Recession, 2007, 2008, et cetera, right? With all those big bailouts we had that make today's bailouts look like nothing, right? But back then, they seemed huge compared to today. They look like chicken feet. And that you'll hear people say these sort of glib remarks. Economists will say this, well, we haven't had any inflation after we printed all that. No, we have. We have had tons of inflation. Yes, it hasn't been as high as maybe some of us would have thought, and I'll agree with that. Mm-hmm. But I don't agree that we haven't had any. We've had very significant inflation. Just look at the cost of healthcare, education. Look at how the cost of the non-measured parts of inflation, like self-service, everything. I mean, back in the old days, Matt, people used to do all these things for us. Now everything is self-service. Not only pumping your own gas, waiting on yourself at a restaurant. I mean, all these cool, trendy, even expensive restaurants, you go stand in line to order your food, and then they give you a number and you pick it up. And it's like, how was that meal $45? I didn't even have a waiter, but they still expect you to leave a tip, right? And that's inflation. It's unmeasured. You used to have a travel agent to figure out your travel plans. Now you do it yourself, right? And so everything is self-service nowadays, and that's hidden inflation too.
Got it. So what are you doing if this is your belief for the next 5 years? What are you doing to prepare for that? And I've heard you say this expression before, and I wonder if this fits in or not. But when you say, "Don't fight the Fed,"
right? Yeah. And that's not my expression. That's an old one. Never fight the Fed. Okay. Because the Fed is too powerful. Governments and central banks are the two most powerful entities the human race has ever known. And if anybody listening thinks they are going to outdo them or fight them, boy, that's just not a good bet. What we need to do as investors is align our interests with these two most powerful forces the human race has ever known, and follow their business plan. And their business plan is very intentionally inflation. They want inflation. They try to create inflation, and inflation benefits them. So why wouldn't we just want to ride on their coattails? Look, philosophically, as an Austrian economist myself, and you probably agree from what I know of you, you probably disagree with what they do, and I disagree with what they do. But so what? They don't care what I think. They don't care what you think. Right. They're just going to do what they want. They're incredibly powerful. And so what we have to do is align our interests with them. And there are many ways we can do this, not the least of which is to go into debt. I know. Everybody's now ready to push pause and skip to the next episode.
Yeah, not so much here, though. I think I've conditioned them pretty good over the last decade. But elaborate on that.
Yeah, so, I kind of jokingly say debt is my favorite four-letter word, okay? Mm-hmm. And when debt is what I call good debt, when it is high quality, low cost, artificially cheap, investment grade debt attached to assets that everybody needs. And it's fixed for 3 decades. Think about it. When someone buys a rental property from us today, right? Either you or me, right? We're in the same business a bit. Not completely, but a little bit. Mm-hmm. There's some overlap. And they buy a rental property. They will not make the last payment on that mortgage, or really I should say their tenants won't make the last payment on that mortgage, because we outsource the debt obligation to the tenant. We don't pay our own debts. Okay. We delegate. And debt is the greatest thing to delegate, right? You might delegate your house cleaning and your gardening, but delegate your debt for sure. Okay. Yes. And that's really good. So we delegate that responsibility to our tenants, and we even ask them to pay us a little extra every month, and we call that positive cash flow. Right. And then we ask the government to give us huge tax benefits, and so it's a wonderful asset class. But the last payment on that mortgage won't be due until 2051 at the time of this recording. That's incredible. I mean, think of all the things that will change over the next 3 decades. They are absolutely staggering. And not only the amount of currency that has been created through the Great Recession, 12, 13 years ago, and now during the pandemic over the last year, and I'm being a little snarky with my word choice there. It was not a mistake, by the way, folks. So enjoy.
Got that on here to talk about it anyway.
Yeah, I got that on here, sure. Hopefully they won't can me. This money, like a chicken, must come home to roost. It has to. It can't do anything else. Mm-hmm. Okay, it has to come home to roost, and it has to create inflation. But in addition to this, in addition to all this new currency creation, we have something called unfunded entitlements or unfunded mandates over the next 10 to 15 years that are beyond staggering. I've had the economist and Professor Lawrence Kutlikoff on my show several times, and he's talked about this. And many call it the $60 trillion time bomb. But he says it's actually about $220 trillion with a T, trillion dollars. Now, I always say on my show, on my podcast, I always talk about this concept. My listeners have dubbed it the Jason Hartman question. And the question is, compared to what? Compared to what? Because we really don't know anything unless we compare it to something else we already understand. So, when we talk about $220 trillion, we have to compare it to something. So if we just look at the GDP of the country, it's around $20 trillion a year. In other words, all of the goods and services that, 328 million people in the U.S., now they're not all adults and they're not all in the workforce, I get that, but, all of these people create and consume about $20 trillion a year, right? That's the GDP, the gross domestic product of the country, right around there. And the gross domestic product of the planet, of the entire human race, is somewhere, don't quote me, it's right around here. It's good enough for government work, as they say. It's about $100 trillion a year. Okay? So over the next 10 to 15 years, the unfunded entitlements and mandates, the obligations the government has already promised without any new promises, which they make every election season, okay, are staggering. How are we ever going to pay for that? Mm-hmm. I say that the way they will pay for it is through inflation. It's really the only way.
Mm-hmm. And that kind of leads me to something that I have written down here, and I didn't know if it was going to fit in or not, but it kind of maybe might be the perfect bridge right there, is you talk about, the promises that we make that we'll never be able to repay. And let me back up. So right now I'm focused a lot on my YouTube channel, mm-hmm. and kind of working that algorithm. It's become like a little game for me to figure out how to beat YouTube, or how to.
Hey, please work on mine too.
Okay, got it. and it's a lot of art, but it's a lot of science as well. Yeah. But part of that is like just going to see what people are attracted to for the moment, right? What are they watching? What are they listening to?
Sure.
And there's a lot of content out there on the Great Reset.
Right.
And
the Great Scam.
The Great Scam. And so, and I've watched a few, but a lot of those videos are really long. They're very detailed, but then a lot of them have like this real creepy conspiracy in the dark type feel to it as well. And I'm not sure what to really believe or not. What is the Great Reset, and what are your thoughts on it?
Well, I'm not an expert on the Great Reset, but I am sure.
Real thing, do you think?
Yeah. Well, yeah, I think, it's a real thing, because at last year's World Economic Forum, Klaus Schwab, who is the founder of the Davos World Economic Forum, and he's written a couple of books. I just finished one, so I guess I'm becoming a little more of an expert. And it was super boring, so I would not recommend his book because it was lame. It was a lot of talk and not much said, frankly. But, no matter what, I think we can all agree that Klaus Schwab is not looking out for us. Okay? He's looking out for Klaus Schwab and the elites of the world. And, we may be rich and successful, but we're not the super mega elite. Okay? Those are the people that run the planet. right? Okay. And I'm not in that club, sadly. So, they're looking out for themselves. And what they want is they, of course, want to gain more wealth. I mean, they're already, multi-billionaires many times over, maybe even richer than that when you talk about families like the Rothschilds, who are the banking family that started in I believe, the 1600s in Italy, and have basically run multiple central banks around the world, right? Mm-hmm. So they're not looking out for our interest. Okay, George Soros is not looking out for our interest. These people want more power, they want more control, and they have these really dystopian ideas about overpopulation and the environment and vaccines and all kinds of stuff that they're not in our interest. I mean, look, Bill Gates wears a nice sweater. He looks like a teddy bear. He seems like a trustworthy old grandpa, but he's not looking out for us. Okay.
Mm-hmm. So the Great Reset, I mean, is that something that we should be concerned with in our lifetime, do you think?
I think so, but I don't know that there's anything much we can do about it.
Oh, got it.
But we should talk about it and make other people aware. That's one thing we can do.
Yeah. And so there's no way obviously there's nothing we can do whether it happens or not, but is there anything we can do to protect ourselves from it, do you think?
Well, I have another podcast besides my Creating Wealth show called The Holistic Survival Show, where I do entertain a few of these theories in a little more depth. Okay. Okay. But, we could go down that rabbit hole and it would take a long time.
All right.
So I'm not, I don't know. I can't say I really thought about it, but, at the end of the day, all we can really do is take care of ourselves and our families directly and spread the word and just, provide the narrative and the conversation and be the opening. And, when you got an idiot on social media, sometimes you have to straighten them out.
All right.
Which is not a productive activity most of the time.
Yeah, no, it never works.
Hasn't worked for me.
Yeah, no, it never. Yeah. I think this whole line of communication that we've gotten as a society on little, 140 character bites. Yeah. It does nothing but divide us even further and just
of course,
worse and worse and worse.
It's pretty sad. I mean,
and form of communication.
And the censorship. People used to argue before I don't even want to call it the ELECTION. If I say the name, we might get censored. But they used to argue about, are the tech companies, controlling speech, right? Well, now there's no doubt. I mean, look, nobody can doubt it now. They took the president of the United States and kicked him off. Okay. Right. That's insane. Yeah.
Yeah. So perfect. Where do we go from here? I never get to talk. I don't get to talk to you as much as I want to. So I'm like trying to scratch everything off my to-do list that Jason Hartman is here. But so let's bring it back down to the ground level. The pandemic, or the plandemic, as you say.
Yeah.
But
COVID 1984, George Orwell. Yeah.
Very good. So this last year conducting business, what were some of the changes that you made to your business that you might actually keep around for a while?
Well, I think like your company, we've been a virtual company since 2012. So it wasn't a big adjustment for us. But I did realize in mid to late February what was going to happen. And I think I was the first one to talk about a few mega trends that I saw. And I really kind of saw them after looking at what was going on in Wuhan and then looking at what happened in Italy. And, having been to China, having been to Italy many times, I realized something, and I think I was the first person to really predict that there would be a mass migration to suburbia. And actually 8 years ago, I predicted that for a different reason. And just know that when I say that, I'm single and I spent most of my life living in suburban Orange County. And I always thought suburbia was kind of oppressive and it wasn't very fun. And I never loved suburbia. I always wanted to, but my career just started there and that's the way it evolved and it would cost me too much money. But I was, had visions of, I want to go live in New York City for 6 months or something, or live in a city. I thought that'd be fun and, more social and that kind of stuff. And I never did it. And, 8 years ago, I predicted, well, really 9 years ago now, I predicted the rise of suburbia because of autonomous vehicles, because of the self-driving car, because, people could enjoy all the benefits of the city without having to drive to it. And that's been slower developing than I think most of us thought it would be. A lot of us thought it would be here in 2016. It only partially got here with mostly Tesla and then Hyundai leading the charge. But it will happen. We will have self-driving cars. And that really changes the game for real estate investors. Of course, you know this. I'm not telling you anything you don't know, but maybe some of your listeners haven't thought of it this way, right? The three primary value drivers for real estate since the beginning of time have been location, location, and location. Mm-hmm. And even if you were living in a cave, okay, in prehistoric times, the location mattered. Did you have a cave that was close to water and food supplies? Did you have a cave that was defensible against, other tribes or animals, right? That was important. The location of that cave really, really mattered. And the location of real estate in modern times has always been centered around cities, right? And ports, especially on waterways, right? And that's changed. That game has completely changed. And it's been changing since 2012 for sure, but it radically changed with the pandemic. Mm-hmm. And it just has completely shifted. And we've seen that in the last year. We've seen this migration out of cities. We are seeing city failures that are now becoming pronounced in New York, San Francisco, LA, places like this that were already in trouble, but this has only accelerated their troubles.
Mm-hmm. And so that is directing your investment focus in other places?
Not really, because I think both of us, our focus was already on these suburban markets, these what I call linear markets, right, where you have good cash flow. But what it did for us, it didn't change our focus. I mean, I don't think it changed yours. I didn't change mine because these were the same markets we were already recommending. Yeah, but yeah, same for you, right? Yeah. But what it did is it brought a lot more money into our markets.
Yeah. Totally.
Okay. So there's this tidal wave. I call it the suburban tsunami. Okay. Mm-hmm. This tidal wave of money that is chasing properties that's moving out of New York City, out of LA, out of San Francisco, out of Seattle, and even out of, other cities that aren't even as big as those, to these suburban markets that really just make sense from an investment perspective. So, all of your clients, all of my clients, they've benefited from this, and our own portfolios have benefited too. So that's been great.
100%. We've taken and I would never even have assessed this because typically every time I buy something, I have no intentions of selling it. Like I'm just holding it. And, but I'm using leveraging this low supply, this low inventory that we have to go ahead and, let's capitalize on some of these challenged and problem properties that are kind of a pain in my butt. Let's get rid of those and maybe upgrade.
Yeah.
And
good idea. I'm moving my portfolio around a little bit because, one of the mistakes I freely admit that I made, in the early days, way back in 2004 or so, I developed something I call the 10 commandments of successful investing. And, there are 10 of them. There's now 23 actually, but we started with 10. And so my 10 commandments, one of them is thou shalt diversify. Mm-hmm. Okay. And I made the mistake of over diversifying. At one time, I owned properties in 11 states and 17 cities. That was a mistake. And I freely admit that was a mistake I made. I went to the all-you-eat buffet. Mm-hmm. And my eyes were bigger than my stomach. Mm-hmm. And I should have just been in 3 to 5 markets. So I'm trying to consolidate my portfolio. I'm doing some 1031 exchanges. There's been some talk that our socialist president, Joe Biden, will take away the 1031 tax deferred exchange, which I think would be terrible. I hope he doesn't, he isn't able to do that. But he is said that he wants to get rid of that wonderful tax benefit for real estate investors. And so I want to do my 1031 exchanges, consolidate my portfolio before, the threat of that. Yeah.
Yep. And so, I mean, we're of the same mindset there, but I'm even looking just from a property management status. Like, I have to keep on fixing this one property, or else I just can't find a good tenant for this property for some reason. It's cursed or whatever. Mm-hmm. And it's been interesting to see, like, in a very short period of time, in places that aren't really known for appreciation, how much the value has appreciated.
Right. Yes.
I've been blown away.
Me too. Like, wow. Me too. It's incredible. I mean, housing prices have been soaring, yet you still have the naysayers out there who say it's a bubble. But Matt, you know from my presentation at the mastermind group we're both members of, that people are looking at that incorrectly. And it's just so sad that they don't understand how it really works. So a couple of examples on that. And, you know, I think we're going to do a webinar together where we go into some of this in more detail. But, you know, just for something to think about, we don't have time to go into it in detail now. But just understand, if you've got listeners who are into precious metals, housing priced in gold or silver is cheaper. Okay. Housing priced on the way most people buy a house based on the mortgage payment, not the price of the house. When you adjust for inflation and interest rates, houses are cheaper than they were 14 years ago. Okay. Housing priced in Bitcoin is incredibly inexpensive. Okay. Now, Bitcoin, I think, is highly volatile, and I think you should be very careful with it. But, you know, it's the shiny object of the moment. Well, maybe not the last few days because it's gone down. So it has big...
Well, it's back up today. So
okay, well, you know, yeah, it's like, see, I'm not a micro guy.
You're right,
I'm not
though.
a
It's volatile.
trader.
That's right, because yesterday was a sad story. Today's it's a good story.
Yeah, you know, it could really, you know, if you're susceptible to moodiness, do not be involved in Bitcoin or the stock market because, you know, it's a pendulum that swings radically.
Right. Let me interrupt you really quickly, though. Can you kind of elaborate of what you mean housing, we'll say gold, so we're not talking about Bitcoin. Housing priced in gold is cheap. What does that mean?
Yeah, so, you know, most people just look at housing priced in dollars, but the dollar, like Bitcoin, is a fluctuating item, right? You know, its value goes up and down. And you can, most people compare it to a basket of other currencies, but the problem with that is that all the other currencies are also fiat money. And fiat, by the way, you know, you hear that a lot nowadays because of the crypto world, so now everybody uses it. But, you know, 17 years ago, when I used to say fiat money, nobody knew what I was talking about. Right. So fiat, the word fiat is not about a car, okay? It just means, fiat just means by authority, by decree, right? So by the authority of the government, you know, the dollar has value because they create what they call legal tender laws that mean the dollar in the U.S. is the currency for all debts, public and private. Look on your dollar. It says it right there. Okay. And if you are selling something, you are legally required to accept dollars. You can't say, I will only accept gold or I will only accept Bitcoin. If you're a merchant, you have to accept dollars because these are the legal tender laws.
I did not know this.
Yeah, so it's a requirement. So, yeah. Yeah, if you open up a store that says you're not going to accept dollars and you're only going to accept, you know, monopoly money or Bitcoin or something else, you know, I suppose the feds could show up at your door with their, you know, with their guns and their bulletproof vest and they could arrest you like they've done with other people who are selling like unpasteurized milk. Okay.
Right.
You know, there's
a relationship between the dollar and gold, whether they're connected or not. There's still a relationship there. So I'm still like, I don't know. I'm not getting how housing priced in gold is cheap.
Well, you know, a lot of people like to use gold, and I'm not a gold bug, by the way. Let me just put that out there. I'm just talking about it because it is a measuring stick. You know, there are many measuring sticks, right? You can measure things in gold. You can measure them in oil or soybeans or silver or cryptocurrencies or dollars, or you can compare the dollar to the euro or the yen or the Brazilian real or the Mexican peso. You can do all of this stuff, right? And so there are many measuring sticks. And the only way we really know what something is worth is by what someone pays for it at a given snapshot in time. You know, a lot of people in real estate, they talk about appraisals. Okay. Well, the only real appraisal is when there's a meeting of the minds of a buyer and seller
and money transacts.
Right.
Now that money, those dollars, are instantly convertible at that time, that snapshot, for something else like gold or silver or cryptocurrency or oil or whatever else, right?
Mm-hmm.
So that's when you know what it's worth.
Mm-hmm.
Okay. But houses, if you look around, we're on a video call right now, even though your listeners may not be seeing that. But if you look behind me, right, this is my house, right? Mm-hmm. And there's a ceiling and walls, and, those are made of things that have intrinsic value, Matt. Everybody in the world needs these commodities. They need concrete. They need lumber. They need petroleum products. There's the insulation in the walls, right? All of these, the copper wire running through the walls, all of those are commodities traded globally. They have intrinsic value. Right. A paper piece of currency only has intrinsic value through law and belief, through fiat, mm-hmm. by decree, by authority, right?
Following you. Okay.
So you could measure the price of a house in gold.
Mm-hmm.
And that is a different amount. That'll tell you if there's inflation or deflation compared to dollars, right?
Mm-hmm. Mm-hmm. Yeah. Super. So you mentioned that we're going to do a little workshop, a little online training next week on Wednesday, and about how you've kind of shifted and how you're investing in the plandemic, and so I'm interested in that. I'm interested in everything that you say and that we've been talking about, and I would love to go deeper, but we've set aside some time to actually do that. And I know there's with your explanations and your whole, I guess, ideas around creating wealth and everything, there's a lot of visuals for us to look at. So I want to make sure that we make those visuals available. So we're going to meet next Wednesday. That's at 3 p.m. Pacific, 6 p.m. Eastern. And if you'd like to join us, you certainly can. You can go to WednesdayWebClass.com. WednesdayWebClass.com, and you can save yourself a seat there. We've been running a few of these and sequential Wednesdays, and they've been really popular and really informative and a lot of different subjects and topics. And if you really want to start thinking about your wealth creation and your future on a different level, like how the wealthiest people actually think about it, not just flipping a house and putting some money in your pocket, but actually to make some long-lasting wealth and create some legacy for you and your family, I really encourage you to be here next Wednesday because Jason has really opened my mind up to a lot of different types of things, and he has a knack for taking these complex ideas and breaking them down and making them simple and easier to understand. So I think you'll be doing yourself a great favor, not just for your present, but your future. Jason, what can they expect to learn? What do you plan to share?
Well, I think what we're going to do is a little bit of a blend of some of my thoughts about, real value, about inflation, about the hidden inflation tax. We'll talk about the mass migration to suburban markets, and some of these different things that people need to be doing to adapt their thinking and their portfolios and their money to the times in which we live. And I know I like to be kind of snarky about some of this stuff because look, the some people call it the cerveza sickness, right? To get around the algorithm. I don't know if they figured out that one yet. And I like to be a little snarky about it because I do think it's overplayed, but it's still real. There's no question it's real. I mean, I've had friends that have had it and they suffered. Okay. It's no fun. So it's a real thing, but who knows how significant it is, right? There's a lot of other real things in the world too that hurt us and make us sick too, right? I think the number 2 cause of death in the country is medical mistakes. Okay, like going to the hospital is a dangerous experience, right? So there are a lot of things, but this one is sort of the perfect thing that has allowed governments to gain a lot of extra control. It's allowed them to move a lot of money around and make certain people much more wealthy than others. And it's allowed them to impoverish a lot of people while making the elites richer and richer. And we know that because the stats are in, the elites, the multi-billionaires are about 30% richer than they were a year ago. It's absolutely staggering. So
that's a huge stat.
Yeah. So what I want to help people do on Wednesday, Matt, is I want to help them get in on this game. That's really what I'm here to do. Okay. I could have retired easily 15, years ago, now 16 years ago. Okay. I don't have to work. I haven't had to work in a long time, but I view this as a mission. Like listen, I like business, I like extra spending money as much as the next guy, but I don't need to be doing this. Okay. Mm-hmm. I really view this as a mission. And I think the middle class, sadly, is disappearing. It's been under attack for a long, long time. And I like living in a country with a big middle class where it's stable, where people are not rioting in the streets. I think that really gives us all a lot of security. Mm-hmm. Okay. Whereas you look at other countries around the world that don't have a middle class or have a very small one, those countries that have massive crime problems, they're just not good places to live. So that's what I hope to help people with. Maybe I know you got to wrap it up here, but I'll leave you with one thought. Sure. I have a couple favorite economists, okay? And I study economics, and this is really my hobby. One of them is a guy named Joseph Schumpeter, and he coined the phrase, or at least popularized the phrase, creative destruction. And we'll definitely talk a lot about that on Wednesday because it's very important, because creative destruction has been accelerated in these times of that we're living in today, right? Mm-hmm. But my second favorite economist is an economist named Richard Cantillon. And he postulated this idea called the Cantillon effect, or other people have coined it that way, dubbed it, right? Mm-hmm. After his death, 250 years ago. And what that basically says is that whenever the government creates new money or a central bank creates new money, the people closest to the money benefit the most. And that's exactly what's happening now. It's happened for a long time. The billionaires got the richest as the money spigots turned on, because they were there first when the faucet was turned on. They were there first with their cup to get the most of it. And by the time that money trickles through the system, the little guy gets it. But by then, a lot of that money has been in the system, so they have to pay inflated prices for products and assets and services. Whereas the people that got there first got all those assets cheaper because they got the money first, right? Mm-hmm. And so what I want to help people do when we do our web class is I want to help them become cantillionaires, okay, where they can get in on the same thing the big guys got in on, right? They're not going to get billions, okay? Mm-hmm. But whatever level they're at, they can play in this game, maybe to a small degree, maybe to a larger degree. I know you've got listeners, and I've got listeners, and we got clients that are all over the board. Some of them just buying their first property, some of them getting 50 properties, right? We both got those kind of clients in our network. And whatever level you're at, you can participate in this Cantillon effect, and it's going to help you. It's going to help raise you up to some degree or another.
That's great. I'm looking forward to it. I can't wait. So if you'd like to join us, and based on that, I can imagine that you would, because I would like to be a cantillionaire. That just sounds like a lot of fun.
You're already a cantillionaire.
I got it. I didn't even know it. But good. Go to WednesdayWebClass.com. WednesdayWebClass.com. It's at 3 p.m. next Wednesday. And that's 3 p.m. Pacific Standard Time, 6 p.m. Eastern. All right, Jason. Well, get your stuff ready. I can't wait to see the show and learn more from you like I have been. So thank you for being here, and I'll see you Wednesday.
All right, my pleasure. I just want to wish everyone happy investing, and we'll see you on Wednesday.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.